Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're going to be looking at a bit of a unique approach to what may be a very familiar options income strategy. We're going to be looking at selling short puts. The difficulty associated with that strategy, especially in an IRA account, is the large amount of capital that strategy can tie up in pursuit of that income. So we're going to be using a different approach to reduce the risk of the strategy, really reduce the amount of capital that's tied up in pursuit of that income. We're going to be weighing the pros and cons of a strategy that I refer to as a covered naked put. Kind of interesting. I'll talk about the pros and the cons of this strategy, lay out how it might be accomplished. A lot to cover, though. Let me first of all say hello. Hello, Janelle and Eva, Will, Paul, Jose, Richard. Who else is here? Ricebird, Sharon, Andrew, Marcus, everybody else. Thanks for joining us week after week. We really do always appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation. Be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let my live stream audience members know that Connie Hill is going to be hanging out in the chats with us today. Connie and I have now been working together for a couple of decades. Connie brings a lot of experience to this discussion. It's great to have her here. Thanks for having my back there, Connie. And Connie and I would like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters on X. That's the best place to connect with us in between these live streams. You can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. All right, but let's get into this discussion. As I do, let me throw this out there. Does anybody think they know what I'm talking about? Because this is my terminology for this strategy, the covered naked put. What does that mean? Should be an interesting discussion. But anyway, as we get into this strategy and others, we need to be aware of the risks associated with investing and with trading. So bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Options carry a high level of risk and are not suitable for all investors. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's get into this discussion. Let's lay out what we're going to be talking about through this the course of this presentation. I want to spend the initial moments, just a couple of minutes, just taking a quick peek at what's going on with the S&P 500 to sort of set the stage, set the backdrop for a discussion of a bullish income strategy that some options traders use to pursue potential income. And it is known as a short put, also sometimes referred to as a naked put, or in an IRA, known as a cash secured put, or also a cash account, carries the same name. But I want to talk about the potential advantages of this approach, but also a very large potential disadvantage of the approach, which is the massive downside risk potential of the trade. And then I want to talk about a variation on a cash secured or a naked put that I refer to as a covered naked put. What do I mean? We're going to be adding a second leg to this position. We'll be seeing the impact, which can be dramatic, and how it might reduce the amount of capital required to sell puts for income, especially in an IRA account. And we'll make sure that we also place an example trade before we're done today. But I do want to also include a discussion within a margin account. How might this be done? Doesn't have as large of an impact, but it still can be impactful. So let's get into this. Let's go right to the Thinkorswim platform. Look at the S&P 500. This is how the S&P is behaving today. Up just a little bit today, but really we're trading right near with it. We're within about a percentage point of all-time highs on the S&P. Stocks have been quite bullish for months. And let's just say that our would-be income investor is just peeking out over the horizon. Maybe they're looking at the next monthly expiration for options, and they're considering possibly pursuing some income, but through a bullish strategy. let's just say that their conviction is that stocks are likely to continue to rise, and maybe there's income potential to be realized in that if that continues. All right, so let's modify our chart here for just a moment, because I do want to be able to see that those approaching expirations for the traditional third Friday contracts. So we can do that by coming up here to our chart settings. Let's click on the little gear icon. I'm going to go to the time axis, and I want to show those expiration Friday, third Friday contracts. And I also need to give this some more room. Right now I'm showing about 10 days, just not about, but precisely 10 trading days of extra area out here in what we call the expansion area. Let's maybe crank that out to, I don't know what it's going to take, maybe 25. Click apply. Yep, that's actually more than we need. Maybe 21 will do. There we go. Good enough. Click OK. But what that just allowed us to see is there's a September 19th expiration. Let's say that our would-be income trader thinks that stocks are just more likely to go up than down through that September expiration. And so they see that as the opening of a window of opportunity for possible income. So let's go get an example stock and set up an income trade on this. And the one that I'm going to be using today is going to be JP Morgan. It could be, I don't like to just slap up symbols and it as though it came out of a vacuum. What are some of the considerations that an income trader trading options might have in mind when they're selecting a stock for a potential trade? Well, could be a number of reasons. We are going to be selling a put today. That's going to include an obligation where someone will have the right to potentially sell shares to us. So typically, a way to think about selling puts is we might only want to do this. Trader might want to only do this on shares they wouldn't mind eventually owning if that's the way the trade plays out. Ultimately, they're probably only looking for the income, but ownership is a possibility. So maybe the trader looks to see, if I get assigned those shares, does that fit within my existing portfolio? Is it complementary to maybe sectors that I already own? Can it maybe flesh out the diversification available there if they have diversification objectives? But they might also consider things like the price per share, the liquidity of the stock, the liquidity of its options, but also what's going on with the chart. So let's see. Paul says, hey, you've got a short put vertical running. Okay, Paul, actually, that leans into this discussion. I'll explain exactly why in just a minute. But let's say that our trader sees that markets look bullish. They want a bullish income strategy, such as selling a put. So maybe they want to look at the stock chart on which they're planning to sell the put and see if it confirms to be also apparently bullish. And you can see with JP Morgan Chase, it's trading near all-time highs, been working its way higher since those early April lows. And we even have a nice white candle today. So maybe they think this is likely to continue higher, could go from where it is right now in the high 200s, maybe going up to 300 or higher. Time will tell. Maybe it does, maybe it doesn't. But what we're going to do today, let's note that right down around that 285 level, I'm going to draw in a line right about 285. You'll notice that the stock has really been finding a pretty good price floor right around 285. And let's say that our trader thinks that that's if stock prices do tend to fall back, maybe that'll be a nice price floor. Maybe that'll be a good support level. So they're considering possibly selling a put at that 285 level, since maybe their conviction is that it's unlikely to go lower than that, even if it gets down there at all. So let's go put a trade in place. And I'm going to direct this trade to our IRA account. This is our example, our paper money account. I'm going to go to the trade tab. Let's go to the 19th of September, and I'm going to sell that 285 put. So that's going to require that we scroll down here closer to the at the money strikes. There's our 285. It looks like it's trading around $2.45 to $2.50. Let's see if we can get 250 for this. Okay. So here is the trade as we're currently planning it. We have our example trade. It would be a naked put. You know, that's not going to be the ultimate trade that we wind up with, but we're starting off that way. So we're thinking about selling the 19th of September 285 put. Looks like we might be able to pull in $2.50 for that. On these contracts, these are standard contracts, 100 shares. That would bring in around $250, just not considering the commissions, which would chip into that just a little bit, but $250 for potential income. Now, let's see. Yeah, Eva, I saw your question. It came in a little bit. I don't know if I'm going to have a chance to really give that some attention today. With my apologies. I'll see if there's a moment at the end. I did see it come in. I was still doing my last minute preparations for the webcast, so I wasn't able to chat back to you. My apologies. Anyway, but what is the motivation for doing this trade? Well, obviously there's $250 on the table. For our income investor, conceptually what's happening here is they're accepting a payment from another trader out there. And that payment is $250. In exchange, though, they're accepting an obligation for the next 24 days or through the 19th of September. Someone has the right to sell us shares for $285. And if those shares collapse in value, tough luck. As long as we're still in these contracts, someone still has that right. They could require us to buy those shares at $285 at any time. So let's go ahead and start to build that trade. I'm going to go to that bid price, and I'm going to click on this to begin selling a put, right? So there's our put. Let's just stick with one contract just to explore this concept a little bit. Selling that one September 19th, $285 put. Let's see, it looks like we might not be able to get $250 for it at this point. Let's say $245. I'll just change this just quickly. Not a big deal. Let's say we get $245 for this. And let's say we insist on that $245. So let's put in a limit order. Obviously, if we submit a limit order, there's not a guarantee that we'll be able to fill for that price. But I want to click on confirm and send. And as we direct this into our IRA, one of the big potential risks, the big potential risk associated with this trade becomes obvious. In pursuit of this $245 potential income, how much money is this going to tie up in the trade? $28,255. So basically, for every dollar of reward potential we have here for income, we're going to have $100 tied up. And this is not always going to work out quite that neatly. In this case, the math works out to be just about exactly that. But yeah, this is a cash intensive strategy in an IRA. Why is it so cash intensive? Well, we need to really understand this contract in order to understand what's being demanded of the trader here. So it's easy to get starry-eyed over the $245 that's on offer. That income can be quite attractive to an income investor or trader, but we have to be mindful of the risks associated with the strategy. We have, for the next 24 days, an obligation, or for the next 24 days, or for as long as we are in the contract, we have an obligation. Somebody can sell us shares for $285 at any time. So that's it. So if we sell this 285 strike, and then the stock, what can the stock do in the next 24 days through September 19th? Well, it could go up, which is great. If it goes up and it's at 300, or even if it goes sideways, it's at 295. Even if it falls back down and it's at 290 at expiration, if someone has the right to sell shares to us for 285, they're unlikely to do that. They could. As I disclosed at the start of this webcast, even an out-of-the-money contract can be assigned. But if this, as long as we're above 285, the trader who has the right to sell shares to us for 285, they don't really have a lot of motivation to do that. But, and London, you asked a question there. Do you like gold, Cam? Couple of things I have to say. My apologies there, London. Number one is, my preferences are never discussed in these webcasts. Of course, I would love to talk about what I like. I think that's a great question to ask, but I'm an educator. I'm not an advisor, so it would be outside the scope of my role to get into my trading preferences. The implication being, if I talk about something that I like, it sounds like everybody else ought to be doing it. I don't know my audience well enough to give advice. It's outside my role. So I need to color inside the lines of an educator. Also, the gold would be going off topic. So in any case, what if this stock were to collapse in value while we're in this contract where we have to buy shares for $285? What if this were to just fall hard? This isn't likely. It's still possible though. What if the stock were to fall down to $250? We have a contract that says someone else can sell us shares for $285. If we have to pay $285 for a $250 stock, there's $35 worth of risk. And you might think, yeah, Cameron, that's not very likely. No, but it's still possible. What else is possible? This could collapse further. There could be some huge bad news that comes out on JP Morgan. And if we just have the bad luck to be in a contract where we have to buy shares, at the moment that news comes out, that stock could absolutely plummet. It's not likely, but it's still possible. And within our IRA, we have to be prepared for every possible scenario to cover the risk. What's the worst case scenario here? What is the worst case scenario for the next 24 days? I'm not talking about probability, not just what's possible. Is it possible that some absolutely horrible news comes out about JP Morgan? I don't know what it would be. And the stock collapses down to a penny. That's possible. It's not likely, but it's possible. Within an IRA, we need to be able to cover that risk. If this stock were to go essentially to zero value, while we have an obligation to buy the shares for $285, what's that risk? Well, we might have to overpay by $28,500 on a 100 share obligation there. If the stock isn't worth anything, but we have to buy it for $285, that's $28,500 of potential loss. It's a very small probability, but it exists. So the math goes like this. Well, if you have a $28,500 potential loss, well, at least you got a small credit to get into this mess. You got $245. So 28,500 minus $245 means, Cameron, you got to come up with the rest of the cash for this. 28,000. What is that? $50? Yep. That's why we're seeing this huge. Let's go back to our trade. If we click confirm and send, we have to cover the difference between whatever we collect here. I did my math wrong. Looks like we're only looking at, well, let's see. We put in, let's edit this. We had this at 245. I didn't lock that. Okay, now we're locked at 245. Okay, so now my math set. Let's revisit that math. So 28,500 minus this 245 that we've collected. I shouldn't have tried to do the math in my head while talking. It actually leaves us with $28,255 of exposure. So when you see this line that says buying power effect, just think this is how much cash is being tied up in this trade. That's how much we would need in cash in the IRA to cover that exposure. Whoa. So some traders might look at this and say, you know what? I don't want to tie up $100 for every dollar that I stand to make in income. That's what they might think of just moving on. Maybe not so fast. There's another approach to this the trader might consider. This is not a sales pitch for the strategy. I'm just introducing possibilities here. What might the trader do to free up the vast majority of that cash, to reduce that requirement of cash? Well, they might use a second put. I'm going to go up here and I'm going to do something that's going to look familiar, but it's going to look different even to our veterans here, our veteran traders. What if I were to go to, let's say, this 230 put? I'm just going to use it as an example, but basically, we're going to go buy a really inexpensive put relative to the amount that we were collecting here. Now, it looks like our prices are changing. Let's change this a little bit. Let's call it 240. Okay. And well, that's not what I wanted to do. Let's bring up our original trade down here at the bottom. Change this again to 240 just to make it more realistic to current prices. So 240 is the limit that we're now requiring. But what we're going to do is at the same time, we look to sell the 285 put. As an example, we're going to buy the 230 put. What in the world is that accomplishing for the trader? I'm going to buy the 19th of September 230 put. And that's going to cost pennies compared to the amount that we're collecting. Looks like it might be 11 to 13 cents. Let's say it's 12 cents. $12. What does that $12 accomplish for this trader? Well, it accomplishes something comparatively enormous. When we sold that 285 put, we know that we took on the obligation that no matter how far the shares fell, we have to buy those shares at $285 for as long as we're in that contract. Someone has the right to sell us shares. The big issue is we don't know how much we can sell those shares for, because as long as the stock keeps falling, the risk in this trade grows. Well, what this does is it defines that lower boundary of risk. We now have an obligation to maybe buy shares for 285, but if we really need to, if times got absolutely desperate, if the stock was completely collapsing in value, we now have the contractual right to sell those same shares for $230. So it's no longer the case that the trader has to come up with money to cover the risk all the way down to zero. Instead, we now know, oh, even if the stock falls to zero, we have the right to sell those shares for $230. That really has reduced that risk. For the cost of $12 or 12 cents per share in this case, we've defined our risk, reduced it from zero all the way up to, yeah, it's still a lot, but it's not nearly as much. Okay? Do some quick math for me. What's the actual risk now? Instead of being $285 per share minus $240 collected, it's $55 per share, because we have the obligation to maybe have to buy shares at $285, but worst case scenario now we can sell those shares for $230. That's a $55 risk. It's a lot less. Now, there is a disadvantage to this strategy. It's not like it's a flawless change that anybody can make to reduce this risk. So I do want to discuss that, but let's add this to our existing positions. So here's our existing one, maybe getting $2.40 for it. But at the same time, we'll go up now to this. What did I choose? The 230. Why did I choose the 230? Just as an example. We could have chosen a different strike, paid more or paid less. There are pros and cons to choosing different strike prices for the long option. But let's stick with this 230. I'm going to hold down the control key on my keyboard and click on the ask price to create a buy order. That adds that to the sell order. And let's unlock this lock for just a moment. And what do you notice has happened here? Our credit has dropped by the amount that it costs to buy that long option. Now, fortunately, the short option has gone up a little bit in price, but you'll notice the net credit has been reduced a little bit. What's the big accomplishment by reducing that net credit, though? Let me lock this for just a moment. Let's say that we're able to do this for a 233 credit instead of 240. If I go to click confirm and send, how much cash is this now requiring even within this IRA account? It's no longer requiring $28,000 to cover an obligation where we might have to buy shares for $285. It's requiring $5,000, $5,300-ish. That's because this now has a much smaller risk. Now, to be accurate, the original trade had limited risk. It was just a very large limited risk, $285 per share. There's still a large risk. It's, in this case, now just $55. So that is what's being accomplished by spending this $12. So we need to be aware of this, though. The trader may just want to think about this as it's a sunk cost. We're just looking, we're going to spend that $12 explicitly to free up cash for whatever purpose we have to do with that cash. The trader, if they don't need the other $23,000 at this moment, they may not even want to do this strategy. But But for others, they may look at this and say, you know what, it is worth that 12 cents to me. It's worth the $12 to free up that cash so I can go do something else with it. What I would like you to do is, as you're looking at this, think through, does this make sense? If I were doing this in my paper money, would I consider this to be a worthwhile trade-off, spending the $12 to free up the cash? Because it really, aside from that, doesn't really accomplish much. Theoretically, it limits the downside risk, but we're still looking at an extremely improbable scenario that the stock would ever even actually fall below 230 before 24 days have transpired. E. Dunny says this would let you use that other 23,000 to make other trades to maximize the income, right? That's true. Yeah. Now, be aware though, let's say that instead of doing one of these trades that ties up 28,000 bucks, maybe since one of these, what I call a covered naked put, but what is more accurately described as just a really wide credit spread, that's really what this is. If we were to do this spread scenario, and we're only tying up 5,300 bucks in one trade, that income investor might say, you know what I'm going to do? I have a brilliant idea. I'm going to go do this 5 times. So I could do a true what we'd call a cash secured put that would tie up $28,000. I can only do one of those if I only have a $28,000 account. Or I could do 5 of these things that Cameron's talking about. Wow, that's fantastic. Maybe. Except if we do 5 of something that carries reward potential, we're also doing 5 of something that carries risk potential. We'd then have an obligation to maybe not have to buy 100 shares, but maybe have to buy 500 shares. So yeah, we just have to be aware that freeing up cash to go do more investing, to go do more trading, means that cash is going to be exposed to its own risk, whatever we decide to do with that. All right, so that is an important consideration. But I think you can see why I call this a covered naked put, because in concept, this really is still a naked put, because boy, there's a lot of exposure to the downside. Let me just draw on a line here. Let me clean things up here. Let me remove this drawing. I'm going to remove this drawing. I want to visualize exactly what we're doing here. We're buying a put all the way down here at 230. And it expires same time, September 19th. What's the likelihood that we actually see JPM fall all the way down to 230, where this is doing us any additional good beyond just freeing up some cash, where it's actually saving us from more risk to the downside? It's not very likely at all, right? So really it's still naked to some extent. Where's the nakedness? Where's the exposure? Anywhere between 285 and 230, this long put isn't really doing the trader a lot of benefit. It's just a step to free up cash. So if that serves the trader's purposes, great. If it doesn't, if they don't need to free up cash, maybe this is not the strategy for them, if they're pursuing income using options at all. But yeah, this is why I refer to it as a covered naked put. Still naked, but for the purposes of cash protection or cash capital requirement, it does cover it. It does influence that math where we can release $23,000 in this case of capital. All right, so that's how this strategy might be applied within an IRA. And I wanted to do this today. Let's go ahead. I want to just walk through the placing of the trade. I don't think I'm actually going to submit the trade, but I want to make sure that we're comfortable with how that trade might be placed. So let's go through it one more time, just very quickly. So to create the order, we'd come to the bid price for the option that we're intending to sell and click on that. And then we go back up to the option chain. And while holding down the control key on our keyboard, go to the ask price for the option that we intend to buy and click on that. And that creates that order. Really, it is a credit spread. Now, we could just click confirm and send here and then manage the trade going forward. How might we manage the trade? Well, this is a bullish strategy. Still a lot of exposure to the downside. So if the stock starts breaking down below the support, if it starts to look more bearish than the trader intended, they may consider just getting right back out. If the stock rallies, great. Well, let's just see if we can stick this out and make that full income. All we have to do is get to expiration conceptually above that 285 level, and this contract expires worthless and we keep the credit. This contract expires worthless and we lose the 12 cents that was just there to free up the cash in the first place. That's the best case outcome for this trade. Now, I have to throw out one final reminder. Even if we're out of the money as we approach expiration, somebody might get a wild hair. They could still assign that short. Let's see. Edani says, if you've already sold the 285 put, could you buy the 230 separately later? Or do both trades have to be? That's a great question. I actually hadn't even planned to discuss that. But since you've asked it, I'll just give the short answer. Yes, the trader could buy that out of the money put. Let's say they put on that trade and they had that $28,000 initial cash requirement. And they decide 10 days into the trade, oh, wait a minute. I just learned about this thing called a covered naked put. Boy, I wish I had done that up front. It doesn't have to be done at the same time. The trader could. It's as long as I can say, I can't always guarantee that a trade will actually get filled, but assuming good liquidity, assuming the trade can get filled, which is not going to be affected by whether we're doing it right now or later necessarily. Yeah, you just buy that put, and all of a sudden it releases that $23,000 of cash in this example. That's a great question. Okay, D. Gwen says, how is this different than a vertical put with a wide strike price? It's not different. That's exactly what it is. Yep. So I have a name for it. I call it a covered naked put, just to kind of make a distinction between the typical motivations of what we might consider a traditional credit spread and this, which is much wider than you'll see lots of credit spreads done. But it really is, at its most basic, just a wide credit spread. That's what it is. All right. So I wanted to show that in our IRA, but I also wanted to demonstrate how this can be used in a margin account. It just isn't quite as impactful. Okay, Gatine says, what if the stock stays under 270? Or in this case, it's actually 285. That's a valid question. If the stock is down here below 285, but still above 230 at expiration, so anywhere in this range, let's just plonk it right there at 270, like the question that was asked. What if we're at 270 and we hit that September 19th expiration? Well, the trader has an obligation to pay $285 for shares that are only worth 270, and there would be very rare circumstances where this contract wasn't assigned, and exactly that's what happened. Now, that contract, someone has the right to sell shares to us for 285, they're only worth 270. They sell us those shares for 285, and we now have a $15 unrealized loss on those shares. And at that point, maybe the trader's just hoping the stock rebounds. But assignment is going to happen with very, very rare exceptions if we're below 285, but above 230. In this case, what happens to our 230 put? It just expires worthless. We get assigned the shares for 270. Yes, we have the right to sell those shares for 230. It's just a bad idea to do that. That would be underselling the value of those shares by $40 in this case. Yeah, that's why I'm saying it's this trade is still naked to a great extent. It's if the stock falls, but it's still above 230 at expiration, that 230 contract just expires. We get assigned, we own the shares for less than they're worth. That's probably not what the trader is looking for. So if the stock starts to break down, maybe they consider just getting out of the whole thing before expiration. But I do want to go through this in a margin account as well. It is still certainly possible in a margin account. So let's direct all of this to our margin account. And if I were to go do this initial trade, let's do the 285. 285, I click on that bid price. I'm going to sell that just an unsecured put, a naked put, sell that 285 strike. Let's say we're able to get maybe 245 for it. As I click confirm and send, how much cash is being tied up in the margin account? It's going to be less than in the IRA. With the IRA, we're required to cover all potential scenarios up to and including the worst case scenario, which is the stock falling all the way to zero. In a margin account, that's not required because it's just highly unlikely that JPM goes all the way to zero. So what is really, let's just say, a realistic number? I hesitate to use that term, but the margin requirement in a margin account is going to be substantially less than covering the worst case scenario because it's so improbable. But we still got to cover what's more realistically possible, and that might be up to like a 20% drop. Most commonly, what we'll see here, this is just sort of a rule of thumb. It doesn't work out exactly to this number each time, but generally speaking, it's going to be about 20% of the maximum loss, right around there. In this case, it's coming up a little bit short of 20%, but just think of it that way, about 20%. So our buying power effect on this trade is about $4,800 of cash to cover if the stock were to fall. Keep that in mind. Let's actually make a note of it. We don't need to. You can just remember $4,812. Well, let's now add that second option. But I want to explore a different strike price for just a moment. Eva, you got some weird thing in the chat? You got an error message? I don't know what. That'd be a YouTube glitch. My apologies. Don't know what that might be. Let's do a variation of the theme that we just did. And instead of buying like the 230, and it's only a few pennies, what if we spent a little bit more money? What if we bought like the 260? That's going to cost us between 45 and 47 cents. Let's call it 45. So if we sell the 285 for 245, and then we spend 45 cents of that, that would still leave us with a $2 credit, the bulk of that potential income. So let's hold down our control key and click on that 260 strike. What are we doing here? Oh, I clicked on the wrong thing. Hold on. Let's edit this. I'm going to have to delete that. Let's sell the 285. I got ahead of myself. Hold down the control key and click on the ask price. There we go. Let's say we want a $2 credit. Here's what we're doing here. In this case, the trader has the obligation to maybe buy shares for 285, but they've limited the downside by buying a more expensive put. We have the right to sell the shares at 260 instead of 230. How much exposure to risk does that leave us with? Well, heck, if we got stuck with the shares at 285, but we unloaded those for 260, that would be a $25 risk. Ouch. Well, $25 times 100 is only a $2,500 exposure. That's not the $4,800 of risk that this was originally requiring. Plus, we get a $200 credit for doing this. So there's $2,500 of risk, but we get to subtract that $200 of credit. So how much is required to tie up in this trade? $2,300. Yep. So I think this is now starting to resemble, I think most of you would think of this as more of a traditional credit spread, but that's all we're doing with this strike that we're buying. We're just limiting the downside. That's what the trader is looking to do. And in limiting that, it also reduces the amount of the cash requirement. Now, I'm going to throw our credit spread traders for a big loop. I think this one's going to really, let's unlock this. And I'm going to go back to, maybe let's get more extreme. Let's go to let's go to 185. I still want to keep the math simple. I'm going to buy the 185 put way out of the money. It probably only cost us a penny or two to do this. But if I were to do this, let's go ahead and lock this. Getting into a contract where we have the obligation to maybe buy shares for 285, but we may have to sell those shares for 185. If the stock were to collapse to zero, that would be $100 lost. $2.40 would be small consolation. That would only be that would still leave us with over $97 of risk per share. But when I go to click confirm and send, it doesn't require $9,700 for this trade. With credit spreads that exceed the truly naked short put requirement, it just stops at that point. So short put, a naked put, about $4,800 on this trade in a margin requirement. Even if we spent the money to try to limit the downside risk, it doesn't accomplish anything. It still only ties up $4,800. And so if you thought that the calculation for a credit spread was always width of the spread minus the credit is how much risk and how much capital is tied up in the trade, nope, actually the margin requirement is going to be less than that. So I think there's going to be a little bit of a surprise there. So I know that one for a discussion of getting started with options. This one's a little bit deeper, but I did want to talk through the pros and the cons of this strategy that I refer to as a covered naked put. It really is just a big wide vertical spread. But I hope this is an interesting discussion for you. The bottom line for our would-be income trader is spending those extra few pennies to free up the cash. Is it worth it? Because the pro is we have more cash to do with what we like for the duration of that trade. The con for doing this, the big disadvantage, is that the investment in that long option is probably going to be lost. That's just sort of an assumption of this trade. So if we spent 12 cents, that's the cost of doing business for this trade. That $12 is just the trader's probably writing that off. All right, everybody, I hope that was an interesting discussion for you. I think this was an interesting take on a familiar strategy. We'll be exploring other strategies. I'll probably ease off the throttle a little bit next week. We'll get into something maybe a little bit more traditional. But in the meantime, I'm going to let you go enjoy the rest of our webcasts. We have more webcasts on the slate for today. I have other webcasts throughout the week. But I want to give you some reminders of the resources you have outside of these live streams. Number one is if this is your first exposure to one of our webcasts, make sure that you subscribe to our Trader Talks channel on YouTube. You can subscribe by just going down the lower right-hand corner, clicking on the subscribe button. It only takes a second. It doesn't cost anything. But our Trader Talks channel is where we house playlists of our previous webcasts. So if you miss a webcast, if you want to catch up, if you want to go deeper into a webcast series, this is where you would find that. So there's our full channel name, Trader Talks Schwab Coaching Webcast. Just search that up on YouTube, go to playlists. You can also join our live streams here, or you can do keyword searches through all of our webcasts, all of our archives for topics of specific interest. Connie, thanks for helping out in chat. Everybody, Connie and I will also issue an invitation to all of you. If you have an account with X, follow us on X. It's the best place to connect with us in between these live streams. So you can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. Vic, you say I nailed it again? Good. Marcus, you like that class? That's good. That's good. I knew it was a little bit of a deeper one for a webcast series called Getting Started with Options, but vertical spreads commonly are placed in that category as among the sort of beginner strategies. This was just a sort of variation on that vertical spread thing. All right. But yeah, you can follow Connie there on X at Connie Hill CS. You can follow me there at Cameron May CS. If you reply to one of my posts on X, I reply right back to you. I try to reply right back to you every once in a while. I don't, so I can't guarantee that I will, but I do the vast majority of the time. And thank you for all of you who've already clicked the thumbs up. That's always appreciated. Got 150 people watching the live stream. We got 54 that have already clicked the like button. That's definitely appreciated. That sounds like applause to your presenter. It also gives a boost to that presenter's webcast in the YouTube algorithm so people can learn strategies like this thing that I call the covered naked put. Everybody, thanks for giving me your time today. Go enjoy the rest of our webcast. I'll see you in a future webcast. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.